Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Crown Castle Inc. Annual Report. Crown Castle is a leading provider of communication infrastructure services in the United States. The company owns and operates a vast network of cell towers and fiber optic cables that support various business needs. At its core, Crown Castle's portfolio includes cell tower leasing. With over 40,000 cell towers across major U.S. markets, Crown Castle offers leasing opportunities for wireless carriers to install their equipment and provide coverage to their customers. Fiber Solutions. The company's extensive fiber network of approximately 90,000 route miles supports small cells and fiber solutions, enabling businesses and communities to access high-speed data transmission and connectivity. This comprehensive infrastructure connects cities and communities to essential services, facilitating the exchange of information, ideas, and innovations that drive economic growth and development. The Crown Castle Inc. (CCI) stock price has remained relatively stable over the past year, with no significant changes of 1.19% or more. Despite several news events that could have impacted the stock's performance, the overall trend has been one of minor fluctuations. One reason for this stability is the company's consistent ability to exceed analyst expectations in its quarterly earnings reports. In the first quarter of 2025, Crown Castle announced adjusted funds from operations, AFFO, and revenues that surpassed estimates, leading to a 1.99% rise in its stock price. Similarly, in the second and third quarters of 2025, the company's results exceeded forecasts, with AFFO per share exceeding estimates despite a year-over-year decline in revenues. However, it is worth noting that the fourth quarter 2025 earnings report and 2026 outlook saw a significant negative reaction, with the stock trading down approximately 7% in after-hours activity. This event would not be included in the list of news events, causing changes greater than -1.19%, as the decline was indeed greater than this threshold. Overall, Crown Castle Inc.'s ability to consistently meet or exceed analyst expectations has contributed to its stable stock price over the past year. While there have been some minor fluctuations, the company's strong performance in its quarterly earnings reports has helped to mitigate any potential negative impacts on its stock price. Crown Castle Inc. maintains a market capitalization of $38 billion, broadly in line with the industry peer group. Crown Castle Inc. trades at a higher price-to-earnings ratio of 35 times and a lower price-to-book ratio of -23.33 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 100% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. The share count has increased, while revenue and shareholder equity are declining. This indicates that management has not yet proven the business model is sustainable. This makes the investment case highly unfavorable. The company have a dividend yield of 4.85%. The income statement shows that the company revenue have been declining annually even though operating income have been improving. Although the drop in revenue is concerning, we can tell that management have been able to reduce cost. The primary drivers of revenue growth and decline can be identified through a review of the financial report. On the growth side, several factors are contributing to increased revenues. The demand for towers is driven by the expansion of 5G networks, increased data usage, and tenants' investment in improving network quality and capacity. Long-term tenant contracts, adding more tenants on towers, and revenue from receivables are also significant contributors to revenue growth. In addition, the sale of the fiber business resulted in a loss of $1.6 billion, but this is an isolated incident rather than a recurring driver of decline. The volume and mix of site development services are also driving growth. On the other hand, site rental revenue declined by $219 million from 2024 to 2025, while services and other revenue declined by $229 million from 2023 to 2024. Other factors that may impact revenues include lease accounting, ground leases for land under towers, term easements, and prepaid lease terms. The company has also implemented restructuring plans, including employee headcount reduction and office space consolidation, which may have both positive and negative effects on revenue growth. The net income of the company experienced a significant decline in 2024 due to various factors such as reduced demand for data and communications infrastructure, unforeseen delays, labor shortages, and increased project costs. This led to a decrease in net income by approximately $200 million. However, in 2025, the net income saw an increase due to growth in the core business and changes in working capital. The profit margins also underwent a similar trend, decreasing in 2024 due to increased competition, technological changes, and government regulations. The adjusted site rental gross margin decreased from 44.1% in 2023 to 47.5% in 2024, but then increased to 48.6% in 2025. This indicates a slight improvement in profit margins over the 2-year period. The net income margin changed dramatically between 2023 and 2024, dropping from 31.6% to -87.1%. However, it rebounded strongly in 2025, increasing to 10.4%. The fluctuations in net income and profit margins can be attributed to various factors such as changes in demand, competition, and regulatory environment. Despite the challenges faced by the company in 2024, it was able to recover and improve its financial performance in 2025. The company's financial performance is a testament to its operational efficiency. A key indicator of this is the generation of positive operating cash flow. According to the annual report, the net cash provided by operating activities was $3.1 billion for the year ended December 31, 2025. This significant inflow of cash from operations demonstrates that the company's core business is generating sufficient funds to meet its financial obligations. This consistent reporting across multiple pages further reinforces the notion that the company's positive operating cash flow is not an isolated incident. Rather, it is a recurring trend that underscores the company's ability to manage its finances effectively. As a result, investors and stakeholders can have confidence in the company's financial stability and prospects for future growth. The company's debt level has undergone significant changes over the years. Initially, it decreased by $7 billion due to repayment on page 35. This trend continued with a decrease in 2025 compared to 2024, as mentioned on page 41. Furthermore, pages 43 and 58 indicate that the debt decreased from previous years for years 2026-2030, and from $23,451 million in 2024 to $21,554 million in 2025, respectively. However, there is an inconsistency on page 52, which states a slight increase of $200 million. Despite this, the overall trend suggests a decrease in debt levels over time. On the other hand, interest expenses have increased significantly by $40 million, as mentioned on pages 37 and 38. This increase continued with a net interest expense of $972 million in 2025 compared to $932 million in 2024, an increase of $40 million. The adjusted EBITDA, which includes interest expenses, decreased by $172 million from $3,035 million in 2024 to $2,863 million in 2025. Additionally, page 52 notes a minor increase in interest expense due to a 1/4 percentage point interest rate fluctuation. Overall, the company's debt level has decreased over time, but interest expenses have increased significantly. The management of the company is optimistic about its future prospects. They plan to focus on tower operations as their primary business segment after selling off the fiber business. This shift in strategy will enable the company to grow cash flows through various means, including tenant additions and new tower constructions. As a result of this growth, the company expects to increase dividend payments to shareholders, providing them with a steady return on investment. Management is committed to investing discretionary capital expenditures in a way that maximizes long-term stockholder value, including acquiring land interests and constructing new towers. The company's stable outlook is underpinned by its long-term lease agreements with tenants and its strategy of providing comprehensive tower solutions through through ancillary business offerings. By maintaining an investment-grade credit profile and using proceeds from the sale to repurchase shares and repay debt, management aims to ensure a solid financial foundation for the company's future growth. Overall, the company's outlook is positive, driven by its focus on growing cash flows, increasing dividend payments, and investing in long-term value creation. The company has undergone significant acquisitions and divestitures over the years. In terms of acquisitions, the company has acquired various companies that are now part of T-Mobile and Verizon Wireless, as well as strategic fiber transactions. Additionally, the company has purchased options for towers from AT&T and T-Mobile, with a total value of $6.5 billion. The company has also made significant divestitures, including the sale of its fiber business to Zayo and EQT through the strategic fiber transaction. This transaction is expected to result in a loss of $3.5 billion in payments due to the termination of the master lease agreement with Dish. Furthermore, the company has discontinued installation services as a towers product offering and non-renewed leases with T-Mobile and Dish, resulting in a decrease of approximately $400 million in site rental revenues. In 2024, the company recorded a goodwill impairment charge of $5 billion, implying a divestiture. The company has also discussed sale proceeds from various transactions, but the amount is not specified. Overall, these acquisitions and divestitures have had a significant impact on the company's operations and financials. The company's financial activities have been marked by significant investments in its shareholders. One notable aspect is the payment of dividends, which demonstrates a commitment to rewarding investors for their loyalty and trust. In 2025, the company paid out $1.565 per share in the first quarter, indicating a consistent approach to dividend payments. Furthermore, the company has also engaged in share buybacks, a strategic move aimed at increasing shareholder value. Through its at-the-market stock offering program, the company successfully bought back shares, thereby reducing the outstanding number of shares and potentially boosting earnings per share. This proactive approach to managing its capital structure reflects the company's dedication to creating long-term value for its investors. That concludes the financial summary for Crown Castle Inc. Feel free to comment below, and I will be happy to answer them when possible.